You know, money doesn't just stay put, it's always on the move. Today, we're diving into an explainer all about the wildly complex, completely fascinating world of foreign capital. We're going to explore exactly how money flows across borders, its absolute game-changing impact on local economies, and how governments scramble to regulate it all. Whether you're looking at India's sweeping 1990s economic reforms or the massive industrialization we've seen in China, understanding foreign capital is literally your key to unlocking modern global economics. So let's get right into it.
Here's how we're going to break things down today. First, defining foreign capital. Second, types and classifications. Third, direct versus portfolio investment. Fourth, roles and benefits. Fifth, shortcomings. And finally, number 6, government policy.
All right, Section 1, defining foreign capital. Let's lay down a really solid foundation.
So what are we actually talking about here? Well, the crucial thing to remember is that foreign capital is a truly comprehensive term. It is definitely not just bags of money crossing a border. It includes foreign aid, private investments, and, this is key, the vital technological and managerial collaborations that usually tag along with the cash. Honestly, whether you're a developing nation trying to build out your infrastructure or an advanced economy hunting for the next big innovation, supplementing domestic resources with foreign capital is just a global reality. From Russia to Thailand to Latin America, the strategic inflow of these resources absolutely dictates the pace of economic development.
Moving right along to Section 2, types and classifications.
Broadly speaking, money enters a country through one of two main doors. On one side, we've got official foreign aid, which operates at the government or institutional level. Think of the World Bank or the IMF, right? And then on the completely opposite side is private foreign investment. This happens at the enterprise level and is driven by private corporations looking for lucrative opportunities abroad.
This brings us to a huge, stark distinction within that first category of foreign aid, and it's absolutely vital to understand this. Loans carry a massive debt burden because, well, they require repayment, along with interest, what economists like to call the servicing of loans. They also frequently come with some pretty strict restrictions on how the money can actually be used. Grants, on the other hand, they're basically non-refundable lifelines. They're usually given out for immediate relief and do not require repayment. But at the end of the day, nations want to graduate from aid entirely. As the old saying goes, it's always better to create trade rather than rely on aid.
Okay, Section 3, direct versus portfolio investment. This is where the private sector gets really dynamic.
To wrap our heads around foreign direct investment, or FDI, we actually look to the IMF's definition. They emphasize that FDI is all about establishing a long-term relationship and retaining control. It's an investment made by a foreign company into a host country, like opening a completely wholly owned subsidiary or forming a joint venture. And actually, joint ventures are a massive part of this. The real merit of a joint venture is that it allows multinational corporations to partner up with local firms, meaning they share the financial risks while blending that global capital with some seriously invaluable local market knowledge. But the demerit? Well, you're opening the door for intense management clashes, and of course, you're forced to split the profits.
Now, there is a super stark contrast between these two types of private investment. FDI is quite literally like buying a house and moving in. You have management control, you are in it for the long haul, and your assets are tied up. Foreign portfolio investment, or FPI, is an entirely different beast. It is highly sensitive, highly liquid, and totally hands-off when it comes to management. An FPI investor is just buying equity in a foreign stock market looking for short-term gains. If they sense even a hint of trouble, they can pull their money out almost instantly.
When it comes to portfolio investment, especially looking at a system like India's, the capital flows through a few highly specific channels. You've got foreign institutional investors, or FIIs. These are your massive global mutual funds and pension funds. Then you have non-resident Indians, or NRIs, who hold a special investment status. And finally, specialized international instruments like global depository receipts and foreign currency convertible bonds. FIIs bring in tremendous amounts of capital, for sure, but they also bring a lot of risk. Because they engage in speculative investments, they can pull out just as fast as they came in, which can cause some pretty wild market volatility.
I actually want to briefly define a GDR, mostly because it's just a brilliant piece of financial engineering. It's essentially this clever mechanism that allows international investors to trade local, say rupee-denominated shares, but they get to do it in dollars on Western exchanges. The local shares are held safely by a custodian, and the GDR is issued against them. It basically seamlessly connects local businesses to the massive pools of capital sitting over in the US and Europe.
All right, Section 4, roles and benefits. Let's look at what this money actually does.
Foreign capital performs a kind of miraculous role by plugging three massive holes in a developing economy. First, it fills the savings gap by supplementing domestic investment when local savings just aren't enough. Second, it fills the trade gap by generating exports and helping manage foreign exchange. And third, it fills the technological gap by injecting modern, super-efficient technologies that a developing nation might otherwise take decades to build entirely on its own.
But beyond just filling the structural gaps, the pros are really extensive. And here we have to talk about multinational corporations, or MNCs. These MNCs take on the incredibly heavy initial risks of developing brand new lines of production. They bring in world-class technical and managerial know-how. They raise the bar across the entire board, enforcing higher standards for product quality and often pushing real wages up for the local labor force. They also provide instant access to massive international marketing networks, which radically boosts exports. But honestly, perhaps the biggest pro is that they force stagnant local monopolies to finally wake up and compete.
I absolutely love this quote from our source material. A satisfied foreign investor is the best commercial ambassador a country can have. It's profound, right? It perfectly captures why nations fiercely, and I mean fiercely, compete for these investments. When you create a regulatory environment where an investor succeeds, they automatically market your country to the rest of the world. Their success literally becomes your nation's ultimate pitch to global capital markets.
But we've got to ask the hard question. As impartial analysts, what is the true price of letting foreign money and the multinational corporations that wield it take control of local industries? Because it is definitely not a one-way street of benefits.
Which brings us to Section 5, Shortcomings. So, evaluating foreign capital is actually a really intense balancing act. Policymakers have to constantly weigh the undeniable comparative advantages we just talked about against some really deep structural disadvantages. If left unchecked, these cons can completely destabilize a host economy.
The data is pretty clear on the risks, especially when it comes to the cons of MNCs. First off, foreign investors naturally chase high quick profits. That means they will often totally ignore a developing nation's actual priority sectors, like critical infrastructure or basic agriculture. Multinational corporations can also become so ridiculously powerful that they start meddling in local national politics. Furthermore, you can develop a really dangerous dependence on their technology, which requires costly ongoing imports just for maintenance. And let's not forget the financial drain. Massive amounts of money often leave the host country early on in the form of repatriated profits and royalty payments. This can severely impact a country's balance of payments.
Okay, final section. Section 6, Government Policy. How do countries harness the good while blocking the bad?
If we trace the history of India's policy, for example, we see a massive structural shift. Back in 1948, the entire focus was on tight regulation and control. But jump forward to July 1991, and we see a total watershed moment, the explosion of liberalization. The government suddenly allowed 51% automatic foreign direct investment in high-priority industries. By the late 90s, they expanded this super aggressively, allowing automatic approvals in dozens of industries up to 74% in some categories. It was a complete paradigm shift from actively keeping capital out to basically rolling out the red carpet. And that foundation continues to dictate the highly liberalized government policies that are operating today.
Which leaves us with a really critical thought to end on today. We've seen exactly how foreign capital can build nations, but we've also seen how it carries the very real risk of extracting wealth and local control. So in our increasingly connected and liberalized world, who ultimately holds the real power? Is it the global investor with the billions in capital, or the local government with the regulatory pen? It is a fascinating balance that every single growing economy has to strike. Thanks so much for joining me for this explainer. I hope it brought some real clarity to the incredibly complex dynamics of global finance. See you next time.